All right, yield nerds, episode 184. Here I am taming the flying Wall Street bull made out of money and making 362% the returns as NASDAQ over the last 2 months. Did I get lucky or did I have a strategy or was it both? We'll find out in a couple of minutes. Well, 495 subscribers, thank you for your support. We have 4 playlists. If you're new, please consider looking at the income investing roadmap that walks you through fixed income and equity investing from a beginner's perspective. I also have a couple of other specialized ones on preferred stocks, munis, and a game that I call Yield Super Bowl to identify the pre-tax yield that is best for every duration. Most importantly, I want to make sure you know that I often say things that may not be right, and I'm relying on you to do the fact checking as well. I've done my own homework, but that doesn't mean I'm always right. So do your homework. Well, let's review the market temperature before we go further. And I appear to be in a little bit of trouble there, but at least in the last couple of months, I tamed that bull, and I'll tell you how it worked out for me. We'll play our favorite yield Super Bowl to see how yields are across durations on a pre-tax basis. And I will show you my returns that are 3.62 times that of the NASDAQ in the last 2 months and counting. And I'll share my holdings that drove it as well. Well, most of you who have watched the show before know that I am mostly in fixed income with a small smidgen in equity, but the smidgen is starting to become a bigger and bigger smidgen. And every week I add a percent here, percent there, and my returns are increasing as well. And so I'm up to 8.2% right now. And if I rewind a year, I was at 2. And that entire thing is not a 400% return over the last year. I have been adding more to equity, but my returns have been very good as well. Now, I allocate my equity across the board in all sectors, but I don't say I need to have a minimum of X on one sector or anything like that. I have an algorithm, I have a filter, and I use the filter and the algorithm to guide what I should buy. I don't go around looking for stocks in a certain sector unless I'm speculating, which I do, but not very often, and my speculations are really small in terms of the overall allocation. Speaking of the allocation, I am harvesting a lot of dividends lately because the fixed income, the short-term rates are going down. And because short-term rates are going down, they used to be 5% a year ago when I had 97% in fixed income, and now it's at 3.6. If you only give me 3.6, I'm going to go look elsewhere for the 5 and 6% returns, and there are dividend stocks that are paying that. So I've diverted a good chunk to healthcare, Bristol Myers, Squibb, for example, stocks like that that pay a high dividend and seem to be on pretty good footing. And in terms of financials, I am now very bullish on regional banks and regional banks such as, and you can look these up, please do your own risk management. West Banco, for example, RF, these are all dividend paying regional banks. As interest rates drop, and you should do your own research, regional banks are positioned to take advantage of them, and some of the regional banks will get acquired by the big dogs. And so I'm making my own calculations on regional bank stocks that pay high dividends, and I bought several of them. When it comes to energy, I do invest in those that give high dividends. So my dividend play is all around focused around these industries. Now, my macroeconomic plays in the last couple of months, unfortunately, we have a lot of global conflict. It's terrible what is happening. Having said that, it does spur industrial growth and earnings in a couple of sectors. And so I do own some of those defense type sectors. In materials, I have a gold position. And finally, when it comes to growth, a lot of my growth targets are in the IT sector. So that is how I think about it. And as I said, I don't go shopping for a specific kind of stock. I let my filters do the work. So how am I thinking about it? And this is a real picture, I want to say from last week when I just got done at the gym, wanting to tame that bull. So let me tell you how the Yield Super Bowl works. And before I go any further, I want to make sure I reiterate that I am not a wealth management advisor. What I am sharing here is my education, and it is not investment advice or tax advice. So my bond strategy is pretty simple. The short-term treasury pays 3.6 something percent state tax free. If I can get a muni bond that pays 4%, now realize muni bonds are federal tax free, right there I have beaten the short-term treasury. Now, if I have to own a 20-year muni bond, I'm not happy with just 4%, so I look for 4.7% as an example, and I look for a yield to maturity that is well north of that. So those are the kinds of ways I think through it. I try to beat the 10-year treasury. I try to beat the short term duration wise using muni bonds and play a tax smart game. And if nothing matches, I don't buy anything. Similarly, on the muni side, a 4.25%, for example, because it's federal tax free, will do magic. On the corporate bond side, 4.7% because it's state and federal tax. That's kind of what you need to beat the treasury. So off late, I haven't been buying a lot of muni bonds because there aren't that many that meet this criteria. And so I used to keep renewing short-term treasuries. There is a hint there, and I'll tell you what has happened. The implication has been that I look for munis. I only look for munis below par, and I try to get the federal tax-free coupons higher than the Treasury interest rates at their respectable durations. And if they get called because the municipality says, hey, why are we paying this much? We should be able to reissue that bond, and they do. I've had at least 24 muni bonds called in the last couple of months, 6 months, something like that. I just reinvest them in another ladder. And so I get that gain as well. And if it has an OID, then I get a tax-free gain. And so if these terms are too foreign to you, I would suggest you go back to the playlist called Muni and watch the Muni bond playlist. Because if you were to buy a municipal bond, example at $99, and there is an unused portion of the OID of 50 cents, meaning the previous person who sold the Muni bond to you ate 50 cents of the OID, and there is another 50 cents of the OID, you get to enjoy that 50 cents as tax-free gain, which is awesome. And you get to collect a higher yield because you're going to go from 99 to 100. So the combination of all of this gives a really high yield to maturity for me, and that is what I shop. And so when I buy them below the accumulated OID and make the tax-free gain and make the federal tax-free coupon, muni bonds are a wonderful thing for me. We talked last week that there is some very serious bear steepening that is happening. What that means is you got to be careful about extending duration on treasuries. So I am not doing that. And I'm actually trying to migrate from treasuries into a couple of other places. So where would I go? I use the Yield Super Bowl to tell me. You may remember from last week that munis are taking over the Yield Super Bowl. However, there is a catch. These munis are above par munis. And once you get rid of the above par munis, the next champion, it turns out, and this is not a CD, but I'm going to try and tell you how I think. If somebody came to me and said, hey, can I give you a CD that pays 6% pre-tax, meaning you have to pay federal income tax and you have to pay state income tax, but the CD pays 6% interest and it's for 2 years, would I buy it? My answer is very simple. If it is from a really stable bank and the bank is going nowhere and I know I'll get my principal back, I will buy it in spades. Now, I am going to clarify that in the quote bank I'm going to tell you about, in that bank, trading volume is low. But if you're okay with holding it for 2 years, then you should be fine. I am fine. That's how I think. You do you. If you said yes like me and said, hey, give me a 6% CD, I will buy it, then I would encourage you to Google, and I don't do politics or product on this show, so I'm not even going to show articles. Why don't you Google, is the Treasury buying mortgage bond securities, mortgage-backed securities? And there are some recent articles about how the Treasury is buying mortgage-backed securities to the tune of 200 billion. Well, what does it mean for them to buy mortgage-backed securities? Well, they need to sell something in order to buy it. They have some amount of cash, they have some amount of assets, And so they are going to sell that. But in order for them to take the mortgage-backed securities off the hands of the bank, that's what that means. In order for them to do that, then they are effectively going to have to find the money to do it. If they are finding the money to do that, and the bank now has extra capacity, which is the whole goal. The goal is to create capacity in the bank to issue new loans at a lower rate so the Fed, not the Fed, the Treasury can buy the mortgage-backed securities. If they are able to do that, then guess what you will see a lot of? You will see a lot of agency bonds come out, and that is exactly what is happening. So when the mortgage-backed securities are getting bought, it frees up capacity. Then the Fed offers to fill that capacity. And here comes FFCB, FHLB. Look at the coupons. They pay 5.2 and they are trading below par. So that becomes a 5.3 and it is state tax free at a 5%, state tax in Illinois at least. Now you're off to 5.6, 5.7, and sometimes you will see 5.42. I bought several at 5.42%, a couple at 6%. So these are the new agency bonds that are coming into the market, and the terms, the durations are going to be long. Some of them may be 10 years, 11 years, 12 years, 15 years. But here is my version of the truth, and you have to do your own homework. What are the odds that interest rates will stay the same versus drop? The agency bond market reacts very sharply to the short end of the curve. When the short end of the curve drops, or when the middle of the curve drops, which it has done a lot, you may remember we saw the bear steepening, the agency will call all of these bonds. Look at the call dates on all of them. All of them pretty much have a call date in the next 3 months. Even the brand new issued bond will have a call date in 3 months. So what is happening, and that's why I call this the 2-year CD, these agency bonds are being issued with rather aggressive call dates. And you just sit here and hold them. Sometimes they'll get called in 3 months, maybe it's 6 months, 9 months, at most 2 years, in my opinion. And so when they get called, you get your principal back. The FFCB and the FHLB are not going to go bankrupt, in my opinion. You have to do your own math. And if they pay well over the Treasury, I'll take the yield. That's the game I am doing. So what's happening to my asset allocation? My Treasuries used to be 90%, are now down to 45. My stocks are up to 8 something. My muni bonds are kind of topping out at 22%, not because I don't want it to go up. I would love to buy more muni bonds. I'm just not finding attractive yields or the durations I would like. What is really going up and above is agency bonds. I used to be at 5%, 7%, 10%. I'm now at 18%. I'm going to keep increasing my allocation as long as I can beat the Treasury at that duration by a nice healthy amount and just wait for the agencies to call it. I have some corporates, but I'm really not buying corporates because it doesn't work well. So the moral of my story in terms of durations is that I am increasing duration. However, it's mostly in agency bonds. My credit ratings tell you the story. Most of my holdings are at the A credit rating. Below B, I have nothing. The not rated is the treasuries because the treasuries are considered cash and cash is not rated. Cash is cash. So then where do we go? Oh, my head actually fits into that perfect profile that I have there. As I grab the bull by its horns, and I'll tell you the next story. This is the growth investment Matador story. Me versus NASDAQ, you can see that I pulled off the magic. In the last 2 months, I've been aggressively closing the gap, and you can see the magical cross. I start beating the NASDAQ when you look at it in a 3-month view. But if you were to shorten it to 2 months, it becomes even more apparent. My strategy of reallocation, my strategy of using the algorithm and letting it guide where I go has paid off in spades. A whole lot of this is squarely because if you look for momentum stocks, in general, you start picking up small cap and mid cap and a lot of Russell, and go look at what the Russell index has done. It has been magical. So I am beating the NASDAQ by a mile in the last 2 months because my algorithm keeps picking Russell stocks. And I'm not guiding it that way, but that's what it keeps picking. And as I focus on dividend stocks, my algorithm once again keeps picking Russell dividend stocks because it has momentum and dividends. And so the returns are showing. So what are my holdings? My worst performer is something that I absolutely love, and I'm not going anywhere. I'm not selling that. That's Cal-Maine Foods. Cal-Maine reported its financials the last quarter, and they beat their earnings by a mile. However, their revenues were kind of growing very slowly, and they said, well, you know what, we are pivoting to higher quality eggs, higher grade eggs, and it's going to take time, and nobody liked that. I love Cal-Maine, the PE ratio of 4 or 5 or something nonsensical like that. And so I'm going to stick with it. It pays a 3.5% dividend, which is not amazing, but I'm hoping when they make more money, they will share more of their profits with me. I'm looking forward to it. The next few are on below par for me. Albemarle UBCP is a regional bank. You can look it up. It's a high dividend regional bank. VC pays 6.5%. RF is another regional bank. USB is not a regional bank, it's kind of intermediate, but these are all dividend paying banks. And then I get into the positive side. These are stellar growth stocks that the algorithm picked and I kept them. Micron, Enersys, Google, you can see it. And you can see that the banks don't really fit there because that's not the model. The banks are on the dividend side. And there are some pharma stocks like Merck, for example, but this is mostly dominated by technology and industrials. There is the middle of the pack here from 10% to 5%. And you can see the industrial stocks, the defense stocks, and gold feature here. Bristol Myers is a dividend stock that is there. And so letting data do my talking is what has helped for me. And overall, here is another regional bank stock called FIBP. West Banco is another regional bank stock. So I've kind of harvested a lot of dividends from there. And so my income is something that is getting bolstered now by dividends instead of being bolstered by treasury. So that's a big change for me. I do have a couple of ETFs, not huge allocations, but they are meaningful allocations. The semiconductor industry, it always impresses me with how wonderfully this particular ETF grows. And of course, another dividend ETF to increase my earnings. My daily routine, I no longer use stop limits. I just let the growth keep going on. And I do have a maximum total holding. So when my algorithm says, hey, this one looks really good, I buy a certain allocation until it reaches a max. When it reaches the max for that stock for me, so for example, I'm just using simple numbers. If you have $1,000 to invest and you will put no more than $15 per stock, you can do however you want to do it. I'm just using examples, hypothetical examples. I may buy $5 on day one, and then every day that the algorithm says this one looks good, I might add $1. So the 5 becomes 6, 7, 8, 9, and it goes up to $15. After $15, I don't add any more and I just stay there. And then the appreciation just sticks on that stock. This is the stuff that you saw earlier. And if, on the other hand, my calculations are incorrect and it crashes, Cal-Maine Foods is one where, right now it's at a low. If the dividend is high, I keep it. If the dividend is low or no dividend, I get rid of it and I follow the algorithm again in allocating capital. That is what I've done. I am in an agency bond binge buying festival by taking money out of short-term treasuries and putting it there for higher income. My worry very much is alive on the treasury market. I really worry there is going to be a problem coming later this year. And one thing that I do religiously is to live below my means. I take manageable risks. I take 7% of my portfolio and take huge risks. I don't gamble away the bulk of my portfolio. I hope you are doing the same. And it's up to you. That would be what I would do. And, invest responsibly. Thank you for listening to Yield Nerd.